Next, recognition for our board members who are present here today. We have Matt Cookson with Cookson Communications, Janella McDonald of Sibler Associates, Ted Kitchens of the Manchester Boston Regional Airport, Trini Houghton of Ripple Effect Consulting, Dr. Joe Favaza of St. Anselm's College, Tom Sullivan of Sullivan Construction, and Sheila McNeil of Whipfley. So thank you all. Our board members are amazing, and they are, the reason that we can pull off the work that we do. So we really appreciate you all being here today. So as you all probably know, Brian Gottlob is going to be our wonderful speaker today. And Brian is the director of the New Hampshire Economic and Labor Market Information Bureau. It's a mouthful, but I think I got it right, Brian? Yes?
Exactly.
So Brian just took this appointment in 2019, right prior to the pandemic, so has had a very interesting ride. Prior to that, he was a principal of POL ECON and founded that firm out of Dover, New Hampshire, and has been analyzing economic, demographic, labor market, and industry trends for more than 2 decades. I will say that this morning on a call with Taylor Caswell, Brian was called the data guy. So this is just so you know, Brian, that was how you were described, and I can't wait to learn from your data this morning or this afternoon at this point. So without further ado, I'm going to hand it over to you, Brian, for the virtual stage and start writing my notes. Thank you so much.
Well, thank you, Heather. Thank you for the invitation. I'm going to share my screen here. Hopefully, there we go. I hope everybody's able to see that. Again, thanks for the invitation. This is one of my favorite events to do. It's a little bit more enjoyable to do in person, and I wish I could see everybody. I won't be able to see everyone in their living rooms or their offices or wherever they may be. So I apologize if I'm not reading the audience and when I need to move on and getting a sense of your boredom. So I'm pretty much on my own here. The thing I'd like to do to begin with is just take a really quick look at what or at least some of the things I presented at the forum last year. And hopefully I'll be able to, there we go. Here are a few of the things I said. I didn't cherry pick these. I picked some that I thought I was mostly right on or correct on. I didn't see anything that I was really wrong on, but these I thought were some of the more significant ones. I did say that 2021 was going to be a good year. It didn't turn out to be quite as good as I had expected, but we did see rapid job growth, quickly declining unemployment, and GDP growth was strong. It was about 1 percentage point slower than I had forecast. That had a lot to do with issues related to the pandemic. I said that it wasn't just the hospitality and retail jobs that we were gaining back, that it was pretty broad-based job gains, and I think that was mostly true. The one where I didn't quite get it, I did see manufacturing as really taking off, but one of the things that's kept that from booming the way I had expected in 2021 is the supply chain issues, which has really crimped manufacturing, not only in New Hampshire, but nationally. Although I think I'm correct in suggesting that medical manufacturing in particular was strong. I fielded a number of requests for labor market information from firms in that industry, even during the pandemic and immediately following it. Well, not that we've actually emerged from the pandemic. I think where I was both right and wrong is on the demographics. I saw New Hampshire's demographics as really getting a boost from the pandemic and people's desire for less density. I thought New Hampshire, being in our proximity to major metropolitan areas in the Northeast, we would see a benefit to that. And certainly we did. Where I was a little bit wrong is that I underestimated how strong that reaction would be. And it's a real benefit to the state. And hopefully will continue in the coming years, that trend. So getting to some of the specifics. All right. I think the US economy is doing really well. I'll talk a little bit about background, the national economy, talk some about the New Hampshire economy, and then try to get down a little bit into the Manchester regional economy. But setting up the background, the national economy is really performing quite well. it's performing better, I think, than kind of the general recognition that households and individuals have. And I have a couple of measures here. One is the University of Michigan Consumer Sentiment Index. I prefer that to the more familiar Consumer Confidence Index because consumer confidence does a better job of measuring what's happening in labor markets. This does a better job, I think, of assessing how individual households feel about their circumstances and about their finances. And the interesting thing about this is that if you look at the most recent couple of months, you see that people feel worse or have a lower sense of where the US economy is than they did during the depths of the pandemic. And to me, that is a real mismatch between what's happening when I look at the economic data and what individuals believe how the US economy is performing. Why is that? Well, a couple of things. One, energy prices and gasoline prices in particular have a really significant impact on how people feel about what's happening in the economy. And because people buy gasoline very frequently, unless they drive electric vehicles, it tends to have a significant psychological impact. And I think that's along with the ongoing pandemic that we just can't seem to get out of, has really weighed on consumer sentiment. Although I will say it hasn't stopped them from spending. Retail sales were very good over the holiday period. They've held up, they've slowed a little bit, but they've been strong even as consumer sentiment declined. The other measure that I wanted to take a quick look at is what's NFIB, the National Federation of Independent Businesses, their Small Business Optimism Index. It generally tracks how individuals feel, but you see, again, over the last several months, and a lot of this is correlated. I don't want to over discuss the pandemic, but a lot of this and a lot of these ups and downs are really associated. If I were to graph cases, pandemic cases, you'd see that a lot of that has to do with how people are feeling about what's happening with the pandemic. So when cases are high, hospitalizations, sentiment and economic activity generally fall. This chart just shows what's happening with the labor market. We got a really strong, surprisingly strong employment report, national employment report for January, over 400,000 jobs added. I'm a little bit skeptical of that because generally that number has been affected or has correlated with or negatively correlated with what's happened with the coronavirus. So when cases are up, generally job growth has been lower. This chart just shows the number of people who indicate that either they themselves have been sick with the coronavirus and they've missed work, or they're taking care of somebody who is sick and they had to miss work. And you see almost 9 million people in the last survey. This is a household pulse survey done by the Census Bureau. When I look at that, it tells me that the labor market is really still strongly being affected, even if those people aren't counted as unemployed or out of work. They're not working fully. They may be getting paid, and thus they're being counted as employed. When I look at hours worked were down significantly across most industries last month, even though the job numbers remained high and we saw a significant increase in employment nationally. The New Hampshire number won't be coming out for another few weeks, by the way. But clearly labor markets, and you probably all are feeling it, a lot of people have been out because of the virus, and your businesses are probably being affected by it. Just quickly, I've changed this outlook. Here's my forecast of what I think is going to happen to the national economy, then I'll move on to the New Hampshire economy. Inflation is going to be a problem this year. We will see the latest numbers tomorrow. December for January, the December number showed a 7% CPI increase year over year. If you average it out over the entire year, it will come out to about 5.1%. Or 4.7% in 2021. 2022, it's going to remain high for several months, although I will say I believe it is starting to roll over. A lot of this has to do with energy prices, vehicle prices, and some other goods prices. But I think after the next few months, and particularly in the summer months, we'll start to see inflation declining and then back to a more normal level in 2023. In terms of GDP growth, again, we'll be a little bit slower in 2020. 2021, I think last year I had forecast 6.7%. It wound up being 5.7. Two reasons for that. One, the Delta variant had an impact on some of the summer months, and Omicron has had an impact more recently, and that has knocked back GDP growth a little bit. Employment growth expectations. This year, I think we'll wind up at about 3.5% for the US economy, 3.4% next year, and a little bit slower in 2023. And I have these question marks in 2023 because I see there are an awful lot of potential downside risks to the national economy, and I'll talk a little bit about those. I have these color-coded, and I've changed them almost every hour since I put this, based on how severe I think the threat is. One, when I say severe threat, the things, what do I mean? The likelihood that it will occur and the severity of the economic disruptions that it will cause. And these could change. Certainly the top four could change. My forecast for 2021, I thought supply chains by this time would be in much better shape. They aren't. They are getting better, but they're not in the shape I had expected them to be. That remains a risk. We still have a ways to go there. The Federal Reserve is likely to raise interest rates for the first time in March, likely 3 times after that, I think for a total of 4. But they're in a very difficult position. They're looking to land a very fast-moving airplane on a landing strip smoothly. They could risk slowing the economy greater than anticipated. So they've got a real challenge ahead. The labor force needs to get back to where it was prior to the pandemic. It has been growing or getting back people into the labor force, but it may not get back as fast, and that's a problem. And the big one is just a tremendous unknown is the international conflict. We've got a situation in Russia, we've got situations in China, and those could severely disrupt commodity markets, oil markets in particular. Russia is the second largest oil producer in the world. If for any reason their oil doesn't go on the market, that will dramatically raise oil prices probably to somewhere in the order of $100 to $120 a barrel, and maybe as high as $150 a barrel should that occur. Interest rates are going to result in asset values easing, if not falling, and if there's an over-tightening, asset values, homes, stocks, bonds could fall further, and that would impact people's willingness to spend. Inflation, I expect to ease by the second half of the year, but it may not, and that would have some, and obviously the COVID variant. Those are a lot of unknowns. So there's far more downside risks in the economy than there is upside risk right now. So let's talk about New Hampshire. I think I showed this chart last year, so this is kind of an update. The blue line here is what was happening with total employment in the state prior to the pandemic. See at the very end there, growth had slowed a bit, and I was a little bit concerned about 2020 and a slowing growth. We had come off a really significant economic boom in 18 and 19. Labor markets were getting very tight. Labor was in short supply, so growth was starting to slow. I still had forecast about 1% and a little bit over 1% employment growth for the next couple of years. Instead, we got this, which is a loss of over 100,000 jobs related to the pandemic. We gained an awful lot back very quickly as the most severe shutdowns were eased. And we've kind of bounced around a little bit. I will say that, and I've spoken to the Bureau of Labor Statistics about this. I have a lot of evidence that I won't go in here, that I think those numbers are underestimating job growth for a number of reasons in New Hampshire. I think that will get corrected in the next month. as we go through a benchmarking process. I won't go into that, but I think it will get corrected. Bottom line is, however, when I work through all the numbers, it suggests to me that by the end of this year, we should have regained all of the jobs back that we lost during the pandemic. That won't get us back to trend level where we would have been had the pandemic not hit, but we will get back, and I expect the US to be in a similar situation. Just putting into perspective where New Hampshire is compared to the rest of the nation, I focus mostly on private sector growth and changes in private sector employment, because I think that gives a better idea of what's happening in the economy, as opposed to the variations that each state have in their willingness to cut government jobs. So private sector job growth, what I focus on, this is just a measure that shows where each state as of December of 2021 is in relation to their pre-pandemic employment. So February of 2020, just before the pandemic related shutdowns, how much below their prior pandemic employment are they in the private sector? And what you see, I think, significantly is that there are a number of states that are closer. They didn't tend to have the same kind of restrictions on economic activity that we did, the shutdowns. The Northeast in particular took very aggressive actions to cut COVID cases. But the other thing that's really significant, I think, is that New Hampshire, among all of the Northeastern states, is closer to getting back to our pre-pandemic private sector employment. And by the way, I do believe that we're actually closer. And again, I would love to explain all the reasons why I feel that's the case, but I think we are closer than this actually indicates, and that will be revised up. And this is good news for New Hampshire and our position in the region. One of the reasons, I'm not going to go into many of them, one of the reasons why I believe we're undercounting, or BLS is undercounting job growth in New Hampshire, it's an estimation process based on a sample of businesses in the state. What I look at, one of the things I look at is entrepreneurial activity, and I measure that by requests for employer identification numbers. And I take a look at a subset of those that are associated with businesses in certain industries that always hire people. They're not sole proprietors, they're not individuals. They're businesses like manufacturers that almost always have employees. Those applications for employer identification numbers obviously dropped during the worst of the pandemic. People weren't going to start businesses, not a great time, but bounced back very quickly. So a lot of it is just a recovery of, initially, a recovery of what wasn't the businesses that weren't formed during the depths of the pandemic. But what we see is that we've seen an elevated level even since then. And these are businesses that won't get into that survey that's done every month by the Bureau of Labor Statistics that goes into the estimating process of how many jobs we've added. These are companies that won't get into that probably for another year and maybe longer. So any jobs that they're adding aren't really counted in those estimates, while the jobs that are lost are counted. Obviously, if a company goes out of business and they indicate they no longer have employees, that count. These don't get counted until later. They will get added in eventually. And when I look at our employment records, our records of companies who have to tell us how many employees and their wages, and that's the basis of the unemployment insurance taxes they pay. When I look at that, I see a significant increase year over year of about 8% in the number of businesses, significantly higher wages. All of that tells me that the BLS is underestimating. Those are two of the things that tell me. One of the things I've done during the pandemic, I think I mentioned this last year, is that government data comes out very slowly. I don't want to disparage an organization that I work with, but the data comes out relatively slowly, not often enough. So I look for more timely measures. One of the measures that I have focused a lot on is the back to normal indexes produced by Moody's Analytics and CNN Business. And what they do is they take about 7 or 8 measures for each state, along with some national measures, and they compare the economic activity in each individual state to what it was prior to the pandemic. So they measure how closely we are performing to where we were prior to the pandemic. And what you see, New Hampshire's the red line, always the red line, US the black line, and just for comparison purposes, Massachusetts. What you see is, you know, we all fell pretty dramatically early on in the pandemic. New Hampshire bounced back more quickly. We all suffered as the second wave hit as the winter and late fall approached in 2020. Again, New Hampshire exceeded in terms of getting back to normal, got very close to being back to normal, and not necessarily in jobs, but in overall economic activity. And then what happened? Oh, we got a Delta variant, and then we got an Omicron variant. And so that has taken a hit on overall economic activity in the state. We're still a significant ways below where we were prior to the pandemic. But again, so much depends on what happens with the path of the virus and the number of cases that could change. And I do expect, as the virus appears to be waning, at least the latest variant, that things will improve pretty significantly. One measure that I focused in on, again, in the private sector, is Google Community Mobility Reports. They track each one of us from our cell phones. They do not track me, however, I'll tell you, because I keep my location off. But they divide up people's trips according to their location services, and they know what the addresses are. They divide it up into retail trips, into workplace trips, into recreational trips. So I've been tracking that, and what you see, and this again compares trips to workplaces, 7-day moving average, to pre-pandemic levels. And what you see is they drop dramatically as shutdowns. We bounced back, got almost always higher than the US average overall. And we got back to about 15% below. And that is a reflection of the fact that more people are working remotely. They will likely continue more people to work remotely. We certainly know that's the case. Unemployment was a little bit higher. But the thing that I think is really significant is that if you look to the far right, New Hampshire, for the most part, had been well above the US. But if you look most recently, you see that that gap has narrowed to the point where now we're where the US is in terms of trips to workplace compared to pre-pandemic levels, which tells me that we have been hit as hard or harder by the Omicron variant than many states. And that's reflected in, at least at one time, we had among the highest caseloads, or the highest caseloads per 100,000 individuals in the state. Taking a look, the key resource, well, this is looking at the employment index. I use indexes a lot here. I apologize, not always the way people look at employment growth, but in order to compare New Hampshire with the US and Manchester with the US, obviously employment numbers are very different. So I use an index number, which basically measures change in employment from pre-pandemic, again, February of 20, to the most recent time period, December, for these state measures and local measures. And what you see is that obviously everybody dropped really significantly. Prior to that, Manchester NECTA. Oh, and by the way, what's a NECTA? I know I should stop there. It's a New England city and town area. It's our equivalent of a metropolitan statistical area. And if you look down to the lower right, I show the towns that are in the Manchester NECTA. It's very difficult to get data for one particular community, Manchester, on a monthly basis. So this is a labor market area, NECTA, that includes all of these counts. So it's not specific to just Manchester, it's the regional measure. And what you see is that, everybody bounced back quickly, but Manchester NECTA has bounced back a little bit more slowly. And I think I have a pretty good idea of why that is, and I'll talk about that in the next slide. But one thing I do want to highlight is that I mentioned that New Hampshire overall has been undercounted in our job growth. And a lot of that has to do with entrepreneurial activity, formation of new business. And I think Manchester is one of the hotbeds of entrepreneurial activity. We'll see some of the larger revisions to employment growth when that all eventually shakes out. But why? Again, why is Manchester? I think it's largely because if you look, unfortunately, the data for the third quarter of 2021 just came out today. As a matter of fact, we just produced it. These are not estimates. These are based on actual company records filed for the unemployment insurance program. So these are solid numbers. The monthly numbers, can't trust them. So the most recent ones that I used were for the second quarter of 2021. And I compared that to the second quarter because there's seasonal differences, need to compare the same quarters of 2019. So before the pandemic. And the things that really struck me about the difference between the Manchester region, Manchester-Necta, and the New Hampshire economy is the loss in a couple of areas. In particular, accommodations and food services. And why would that be? Well, the Portsmouth area and other areas have a lot of tourism activity, a lot of restaurants, but those were less dependent on business travel. They're not centers for meetings and conventions the way Manchester is. We know based on data from the Manchester airport that a lot of activity slowed during the pandemic. I was supposed to attend different events and conventions in the Manchester area. All of them got canceled. So I think that took a particular toll on your region and is a big contributor to why job growth in your particular region has suffered maybe more than some other areas, because there's other areas of strength. You didn't lose as many healthcare jobs. That's in the middle of the chart there. Didn't lose as many manufacturing jobs. Saw more transportation and warehousing jobs. The real significant difference, information as well. Information is data processing, but also media. Manchester is a center of media, not only print media, broadcast media. So I think there's some unique aspects of the industry mix and who you serve that contributed to that. I don't believe the Manchester economy is in worse shape based on some of these numbers than the New Hampshire economy. As a matter of fact, I'm actually more bullish. I think there's many more positive things that are occurring in the Manchester region than in New Hampshire. Entrepreneurial activity being one, some of the key industries, you have a real strength in professional services, you have a real strength in technology industries, a real strength in defense industries, things that I expect over the long term will bode very well for the region. I did want to take a look at job postings because, there's one, the fact that jobs aren't back to where they were is not an indication that there is less demand for labor. As a matter of fact, there's more demand for labor. This is a chart, again, I use an index number because to put them on the same scale, it would be difficult. So this just compares the number of monthly job postings in the Manchester-Necta to the New Hampshire economy overall. And what you see is that both areas, both regions have seen greater job postings than they had prior to the pandemic. There is tremendous demand for labor. The labor market is strong. So what's holding back is more having to do with the availability and the ability to match individuals to jobs that are in demand. Just taking a look at where those job postings are coming from, and this is particular to the Manchester-Necta, just taking a look at broad industry groups. I could break this down into individual companies. I could break it down into individual occupations, but a couple of things. Healthcare and social assistance, we know healthcare jobs have been in demand. A lot of these industries had strong demand prior to the pandemic. Retail trade always has a lot of job openings. Why? Because people churn in that industry. They leave it. Maybe it's their first job, or they leave from one job to another. So there's always a lot of job posting. But I think what's really significant about this data is that some industries that are well-paying, high skill, in jobs that have industries that hire well-paying jobs in high skill occupations. So finance and insurance, professional, scientific, technical services, which I think is a real strength in the region, and manufacturing. So when you add all those up, the percentage of jobs that are in high-paying, well-paying jobs and high-skill occupations is really strong. I wanted to focus on just on a couple of areas. Manufacturing. We know that healthcare, just tremendous job needs in that area, but I just want to focus in on two: manufacturing, comparing it to where job postings on a monthly basis were prior to the pandemic. They're actually higher than they were prior to the pandemic. Professional, scientific, and technical services, again, I think a real strength in the Manchester area, as they often are in larger cities in a state, the largest city in the state. But each of those has stronger job postings, greater job postings than they had prior to the pandemic. One of the reasons why, and this isn't so much true in professional services and manufacturing, but one of the reasons why we have so many job openings is we've got really high quit rates. People are leaving jobs, and you hear about the Great Resignation, not necessarily stepping out of the labor market, but they're changing, and that's particularly true in lower skill occupations and industries that pay less wages. I look at wage rates and how they've changed. They have changed and increased the most in some of these lower paying industries and lower skill occupations. So those people are hopping jobs. There's also young people tend to change jobs a lot. We've got a lot of young people who have entered the labor, millennials have come into the labor market. They tend to change jobs. Bottom line is, however, New Hampshire has one of the highest quit rates of any state in the nation. Why? We've got a lot of opportunities. We've got wages rising really rapidly, particularly in lower skill industries and occupations, and that contributes to really high quit rates. This is what I think this is national data, by the way, but one of the realities of what you all are dealing with as employers is that employers are paying workers to stay. And this is, a lot of people hate scatter diagrams like this. I love them, but it shows two things. On the bottom axis, the x-axis, as you move to the right, that's the increase in quit rates in an industry over the past year. So how much have they increased? Accommodations, food service always have high quit rates. So I'm just looking at how those have changed over the last year. On the left scale, the y-axis, it shows a change in the employment cost index. And that's not just wages, that's total compensation, that's benefits, that's everything, and how those have changed. And this is, again, national data. And what you see is the more quit rates increased in an industry generally, the higher the compensation increases. So industries, businesses are paying people to hold on to their people. And you look at professional technical services, not that big of an increase in wages, finance, insurance. I did look at, because we don't have an employment cost index for New Hampshire, but we do have like hourly wages. I looked at accommodations and food services change in hourly wages over the last year. And that's not a complete measure. Employment cost index is great because it controls for the type of jobs. So if you lose a lot of high wage jobs or lose a lot of low wage jobs, that doesn't affect it, controls for that. Accommodation and food services over the last year in New Hampshire, the wage rates increased about 14%. That's really huge. So they're making out better than the rise in inflation. Labor force going to be critical. Two areas in New Hampshire that had been doing very well. This compares Manchester, NECTA again. The gold, I think that's gold color. I'm a little bit colorblind. Gold color. Blue is the Seacoast area, and red New Hampshire. and compares it to the black line, which is the US. New Hampshire labor force outside of the seacoast and the Manchester area growing pretty slowly, real problem. But both the Manchester and seacoast areas had seen pretty good labor force growth. Manchester looks like it's still declining. I'm very skeptical of that. I think that will again be adjusted up. I'm not buying that. But that shows that, you know, those are two regions that are attracting ability to attract individuals, to keep individuals. And that bodes well in the future. Only two areas that really have seen any kind of significant labor force growth. Big issue for the state, people stepping out of the labor force. That's true nationally as well. This measure here just shows what would our labor force be like, how much would it change if we had 2019 labor force participation rates applied to population numbers in each of these age groups. Two groups that have really stepped out of labor force, older folks, a lot of early retirees, record numbers, record percentages nationally. Haven't been able to get that data for New Hampshire, but I'm sure it's the same. So people having seen their retirement accounts increase pretty dramatically over the last few years, housing values, maybe they feel more comfortable stepping out, also pandemic related concerns, health concerns. The other groups, young people, that number is getting a little bit better. 25 to 29 tends to be males. A lot of them stepped out of the labor force. Why? Well, a lot of them got pretty generous benefits when they were laid off for various reasons. They got fiscal stimulus money, so they can ride out. If I were 25 years old and wanted to take the summer off, this last one would have been a good one because I would have gotten a few $1,000s from the federal government, collected some unemployment, and I could wait a little bit longer to get back in the labor force. It is getting back. I did this a month and a half ago when it was 5,300. The other group, 35 to 39, tends to be more women. Why? Well, that's a prime age group for women with young children, ages 6 and under. They've had the biggest issues related to childcare, and I think that's been a significant impediment to getting that particular age group back. But 22,000 overall. Almost done. This is the thing that has been the biggest and most pleasant surprise, also where I probably made my biggest forecast error, although if I'm going to make an error, this is the way I want it to be. Increasing in teleworking, desire for less density, gave a big boost to New Hampshire's net in-migration, 2020-21 to the right there. I had forecast 6,500 increase, which was a pretty significant increase over the prior year, wound up being 13,608. So really significant. That bodes very well. I don't think this is yet reflected in those labor force numbers. I think it will. It potentially provides, you know, a boost for employers, although a lot of these people are going to remain working outside of the state. And by the way, you know, it looks good to our labor force, but I'm seeing a lot more companies from outside the state looking to rob our talent. I'm seeing a lot more job postings from places far and away because of the ability to work remotely. Just putting into perspective again where New Hampshire stands, this is that net migration number, state to state migration number you saw as a percentage of 2020 population. So both New Hampshire, Maine, all of northern New England did well. New Hampshire and Maine did particularly well. So we saw that desire, again, those northeastern metropolitan areas, strong desire for less densely populated areas. New Hampshire and Maine were primary beneficiaries of that. Just again, focusing on Manchester, big issue from my perspective. I hate to focus on one demographic group, but millennials are so critical to the labor force because they are our nation's largest demographic group in history, and they're flooding into the labor market. They've been in for a while, but more of them continue to flood into the labor market. Whoever captures them is going to see a real benefit. One of the ways that we capture them is by offering them opportunities to live in our communities. What attracts them? Well, amenities, social, cultural, natural amenities. Manchester has a lot of that, a lot of social and cultural opportunities. Other communities do, particularly in the seacoast area. But rental housing is critical. Another one of my scatter diagrams that everybody, except for me, hates. On the bottom scale, the x-axis, As you move to the right, that's the percentage of housing units in a community that are rentals. On the left axis, y-axis, the vertical axis, is the percentage of that population that is roughly millennials, 25 to 34, don't have an exact breakdown there. But what you see is the greater the opportunities for rental housing, because young people aren't buying houses as quickly, they're oftentimes renting. The greater that percentage, the greater the percentage of millennials. Manchester being at the top of that, but even more so is Seacoast community. So Manchester, by offering rental housing, and you've got some in the works that I think are really, setting Manchester up to capture an increasing percentage or an increasing number of that group that's looking to migrate. And by the way, if I broke that down, you'd see that the migration is tending to be younger. We're seeing more 25 to 29-year-olds move into the state. So I think Manchester is well positioned. Some of the things that you're doing, some of these communities will not allow any of that rental housing and will never see that benefit, and their communities will continue to age at a relatively rapid rate. Again, housing, one of the problems is that migration could be stalled because of a lack of housing. And this is just for sale housing. So it's not rental housing. I don't have a measure of active listings for that, but this is a measure, again, an index number of what's happened to active listings of homes for sale. And what you see is that it's declined almost 80% in Hillsborough County. So there's many fewer places for people to purchase, which means if they are still going to move here, they're likely, a lot of people are going to be in the rental market when there's not people who would naturally be moving from the rental market to the housing market remain in the rental market. And as millennials flood into forming their own households, you put a lot of pressure on the rental market, which is one of the reasons why rental prices are increasing so dramatically. And a big factor, by the way, in that inflation number that I talk about, that is an undercounted impact and is likely going to continue. Problem is, we've got things that we could do, and this is just what's happened to or purchase prices on a per square foot basis. Again, I think Hillsborough County, don't have it for Manchester, Hillsborough County has an advantage. When you look, Rockingham County is pricing itself out of the market. I live in Stratford County and I've seen a benefit of that as more people have moved into my, I've looked, and unfortunately the data stops in 2019. I looked at IRS data, migration of where people move based on where they file their taxes, seeing more people move from Rockingham County to Hillsborough County. And when I look deeper at that data, I see that based on the number of filings that they have, number of tax returns filed, and the number of exemptions on those files, it tends to be more single people. So we're seeing, Hillsborough County tends to lose more families, but it's gaining more people who are single and younger. The problem with the housing issue is that we've got regulations that are preventing it being built. We've got communities that don't want to build, but we also have structural issues or business cycle issues. We don't have enough materials. We don't have enough labor to build. We don't have enough land on which to build, and the costs of materials. So it's a real difficult problem that can't just be solved by regulations, although that will, and zoning regulations, but that will help. Last chart, because I think I'm running a little bit over here. Just my forecast of employment growth for New Hampshire and the state. I will say, I think last year at this time, I think I had forecast 3.8% for 2021. We are at about 3.4% now. I think that will be revised up. I don't know that we'll quite get to 3.8, but I feel pretty good about it. I think we'll slow a little bit next year. And then I do have some real concerns about 2023, and I articulated a little bit of that in one of the first slides I showed on the national. There's a lot of things that could potentially have negative impacts, but I'm still holding to a positive employment growth outlook. And I know I covered a lot, but I'm going to stop, and hopefully I didn't lose too many of you folks, and I'll be able to answer some questions if I still have a voice left.
Thank you, Brian.
All right.
The notes were in full swing over here. I know that. Yes, so we did have a good amount of questions. One of them is sort of, you started off with some of the COVID trends. And business owners are wondering if they should incorporate a seasonality to their business planning, given the high probability of that remaining for a while as far as variance and rise in cases.
Yeah, I mean, I think they're clearly, and I'm not an epidemiologist and not an expert, but it does sound like we can expect that there will be seasonal variations. I mean, we've seen it throughout the pandemic, and we've seen cases in the warmer months decline, economic activity increase. The opposite occurs as people move indoors. One of the factors, I have tried to include pandemic impacts in my forecast, and one of the things I have included is I do think there'll be continued variance, but I think we're getting better, despite the fact that more people have caught the Omicron variant, or Omicron, however you pronounce it. We're getting better at handling it. We're seeing fewer shutdowns. We're managing it better. So I think each one has a little bit less disruptive impact on the economy. But I think businesses clearly, people's willingness to, I look at one of the charts that didn't make it into this presentation. I have twice as many charts, cut them out, was one on restaurant reservations in the state. And you just see how they declined as the Omicron variant picked up. People's willingness to engage in normal economic activities declines at those times when the virus picks up.
That makes sense. Okay, thank you. It's great to hear the net migration numbers are skyrocketing. Which
really exciting. Those are 1980s kind of numbers, by the way.
Oh, even better. Yeah, because I think it was about 6,000 to 8,000 the last 5 years, and is now over 13,000, right? Is that?
Yeah, we had seen negative, which was unheard of, because in the 80s we were seeing regularly in the teens. We had a period just around the Great Recession and following where we actually saw negative, and that had to do with some of the demographics of who we typically attract. We had attracted a lot of families, two-wage earner married couple families, likely both college educated with kids, because we import our children. And during the Great Recession, a lot of people in that age group, if they probably owned a home somewhere else, they would have wanted to sell it to buy one here. Could have been underwater, really difficult. Migration was slow everywhere, but our characteristics of migration, net migration, made it especially difficult for people to move to New Hampshire. We've rebounded somewhat, but the pandemic and remote work opportunities really position us very well. Again, still a challenge. I mean, it's great for our demographics. Whether it's great for each individual business will depend on how competitive they are for that talent that works here, especially if they don't have to commute anywhere.
Yeah, well, that you just predicted the follow-up question was, do we have data on how much of that migration is actually working in Manchester and New Hampshire, given the remote world?
Yeah, we will. We don't right now. My estimation is that much of it is working elsewhere.
Yeah.
And I'll tell you, that's not unusual, because when we saw our very high migration rates, particularly in the 80s and parts of the 90s, a lot of those people moved to New Hampshire for whatever reason, a little bit cheaper cost of living, whatever, they like the environment more, but a lot of them continued to work in Massachusetts. That was not unusual. What it did do, however, is they show up in our labor force numbers as talented, skilled, well-educated individuals, and it made us more attractive to businesses who are looking at New Hampshire. So eventually we created those opportunities based on people who may not originally started working here. And I think that's will happen here. We're adding, when I have a whole presentation on who moves here, almost 50% have a bachelor's degree or higher, compared to about 30% or a little over for people who, are natives or who live here or haven't moved here in the last few years. And 60% have an associate's degree. So a post-secondary degree. 60% of the people who move here, typically from another state, are skilled, well-educated individuals. We add to our talent pool dramatically by allowing those people in. Eventually, somebody in New Hampshire is going to realize, and maybe, unfortunately, wage rates can be very different. It may put upward pressure in order to compete on wages in New Hampshire.
Awesome. The next question that we had was, can you elaborate a bit on the interest rate projection as well as the oil prices and how they'd be adjusted to the Russia-Ukraine conflict progress?
Yeah, yeah. Well, I didn't project interest rates. We do know the Federal Reserve has indicated that they are likely to raise interest rates at the March, their March meeting. The consensus is that they'll probably raise a quarter of a percent, and then 3 more times at each quarterly meeting they're likely to do that raise. So that's not really, I don't really forecast interest rates, but that's kind of the expectation. They've signaled that. In terms of the oil prices, that's based on Russia's supply of oil to world markets. So if you subtract that, you get to, and it's perfect. I mean, anywhere between $100 and $150 a barrel. Right now, we're hovering around $80. We were lower than 60. I had done some work for energy producers in the West Texas Permian Basin area, and at that time, when oil prices had to be about $60 a barrel in order for producers to produce. One thing that will occur is that prices will go up, and that will induce more production from the U.S. U.S. is a high cost producer. Saudi Arabia can produce a barrel of oil for under $20 a barrel. In the U.S., it's $60 a barrel or higher, and getting higher as we have to do. It gets harder and harder to find. We've got plenty of it. It's just harder and harder to get out. So more drilling rigs will operate. Prices will stabilize. But if you subtract out their and other people will produce, but if you subtract out their volume of oil, kind of a median would be about $120 a barrel. We would go from current 80 to about $120 a barrel. Eventually that would change as more production from other areas increases. I say this all the time. It's an axiom of economists. The cure for high prices is high prices, because when you have high prices, you induce more production. It will have an impact because, that will lead gasoline prices to be, close to $4 a barrel, or $4 a gallon. And I showed you what happens with consumer sentiment when gasoline prices rise. Right now, it hasn't had a huge impact because households have some pretty good savings. The stimulus gave them extra money, so the higher gasoline prices haven't really bit into their spending, but eventually it would. So every penny increase in gasoline prices takes away about $1 billion nationally of expenditures.
Okay, thank you. One of the other trends that we've got a question about is the unretirement rate.
Yeah.
And if you've seen any data or at least anecdotal trends in that area. Yeah.
Well, no, I haven't. There's a lot of speculation on it, and it will take time. We will get some data on it. The thing we know is that I said this on a percentage basis, people who are eligible for retirement but don't typically retire, that kind of between 60, 64, number of people filing for even 65 and above, filing for Social Security as a percentage of eligible was at record highs last year, like over 2 million more people nationally. Don't know what that number is in New Hampshire. Again, a lot of those people thought, oh, inflation's low, my savings, my retirement, my nest egg is probably good enough to get me. Things have changed a lot over the last year. We went from inflation under 2% to 7% in December. Maybe people are thinking, maybe, and asset values as interest rates rise, it's going to take the edge off. And we've seen some decline in the stock market. It will probably, we'll see some declines in asset values as interest rates rise. That's natural. People may rethink. So I do expect a little bit of that to occur. When I break that out, by the way, when I look more deeply, which the last thing you need right now is me looking more deeply at anything. But when I look more deeply at that demographic group and who stepped out, it tended to be more what I think looks like second wage earners. if it were a married couple family, tended to be more women stepping out in that age, probably because they felt like, well, we don't need that second income as much. So, maybe some of those people come back, but certainly not all of them are going to.
Yeah, it's an interesting strategy because we see employers getting very creative with their hiring. So this is a whole new pocket of messaging to the retired.
Well, I had counted on, and we saw it in the numbers, older people were working longer. They were working longer, not just because they had to, but because more of the jobs we have require less physical ability. If I'm sitting at my computer, I don't, it's not like I'm on a roofing, I can do it, well beyond it when anybody will want me to do it. And so we were seeing increases in labor force participation among older individuals. That got reversed in the pandemic, and some of it will change, but I don't know that it will come back completely.
Yeah, thank you so much. We're already out of time. We could go on and on, I know. One of the thoughts I don't want to get lost, that is, I quote, Manchester is a hotbed of entrepreneurial activity. So if you remember one thing from today, I loved that line. Yeah.
Well, it traditionally had been, but you see it. I mean, my goodness, you've got, just some wonderful companies that are sparking spinoffs. I mean, you've seen it. You've had companies. You've had companies like Dine that have seen individuals leave that organization to start other firms, and I don't want to single out just one, but there is that culture there. And I tell you that if there's an asset that a region can have, that is the best, because when you have entrepreneurial activity, you assure a level of dynamism. So industries rise and fall, they change, industries are hit by economic conditions, but if you have that entrepreneurial activity, you will catch the next wave. And you see it whether it's Army and and that initiative, you're catching the next wave. And I fully expect, given you've got that core of entrepreneurial activity and spirit, that I think will continue to bode well for the region. So you happen to be suffering from some of these industries that have been particularly hard hit during the pandemic, but that too shall pass.
Yes, it's great to hear you say it, because all of those of us involved in the business community know we're an entrepreneurial hub. But when you put some data behind it and show it on a slide, it gives it that much more credibility. So thank you for that. So I just want to take a moment to thank our presenting sponsor, TD Bank, who is a partner for our economic development pillar all year long. We really appreciate your support. And also our investing sponsor, CMC, and advocate sponsors, Members First Credit Union, Outfront Media, and Whipfly. Thank you so much for your support. A quick plug to upcoming programming, because it's so relevant to this topic. We also have an event that we are promoting in conjunction with the World Affairs Council, that is Global Tipping Points. That is a series on supply chain expertise. So if you haven't caught that in our e-news, stay tuned for their upcoming programs. It will be very relevant to the materials we discussed today. And as far as the chamber, we have our State of the State coming up at the New Hampshire Institute of Politics on March 9th. That will be at 3:30 in the afternoon. The State of the City, same location on March 23rd. And we have our Diversity, Equity, and Inclusion Forum, Retention Through Belonging, which will be April 6th. So definitely, I hope you can join us for those. We thank you for joining us today. And Brian, thanks so much. I'm much smarter now, so appreciate it.
Well, thank you for the invitation. Really great. I tell you, I love this, and I look forward to, if I haven't worn out my welcome, doing it next year.
Oh, wonderful. We love that. He's in, Corinne. Yes, that's great. Wonderful. Thank you so much, Brian. Everybody have a great day.
Take care.
Great day.